This is Barry Zalma on insurance. I'm an attorney who is retired from the practice of law and now spend my time as an insurance claims consultant and expert witness and author and producer of these videos. Today, I'd like to speak about the real effect of the tort of bad faith. It is indisputable that in the 1950s, 60s, and 70s, the insurance industry abused some insureds to avoid paying legitimate claims. Without a factual basis, insureds were accused of arson and other variations of insurance fraud. Indemnity payments were refused on the flimsiest of excuses. People were found to have diseases that only horses could catch. Disability payments were refused because an insured was wheeled in her wheelchair to church one day and therefore was not totally house-confined. Insureds were driven into bankruptcy when reasonable demands within policy limits were refused. To stop this abuse, the courts of the state of California invented the tort of bad faith. It took a universal contract remedy and decided that breach of an insurance contract without what the court decided was proper, genuine, or even fairly debatable reasons was transferred from a contract breach into a new tort. Many other states have followed the lead. Until the invention of the tort of bad faith, all that an insured could collect from an insurer that wrongfully denied a claim were the benefits due under the contract. After the creation of the tort of bad faith, the courts allowed the insureds to collect, in addition, the entire panoply of tort damages, including punitive damages. No other contract worked that way. No other breach of contract was entitled to tort damages, whether it be a sale of a house or a car or the purchase of a widget. Only contract damages were available. Insurers, on the other hand, were treated differently, and it worked. Insurers treated their insureds better. The threat of punitive damages made insurers wary of rejecting any claim. The creation of the tort of bad faith was in many ways a good thing for some insurers and some insureds. What the courts that created the tort of bad faith did not recognize, or did not care about, was that it was also the key to Pandora's box of abusive lawyers who found it to be a new profit center for their law practices. The law of unintended consequences struck with vigor. Lawyers flocked to every available courthouse to take advantage of the new tort. The law of unintended consequences is defined as the understanding that actions of people, and especially of governments or courts, always have effects that are not anticipated nor intended. Insurance is controlled by the courts through appellate decisions and by government agencies through statute and regulation. Compliance with the appellate decisions, statutes, and regulations different in the various states is exceedingly difficult and expensive. Even if a claim against an insured is fairly debatable, an insurer is nonetheless obliged to engage in settlement discussions in an effort to relieve the insured from the burden and expense of litigation. Therefore, insurers must understand that even if the lack of coverage is genuine, even if there is a genuine dispute and that dispute is fairly debatable, it still may be held to protect the insured regardless of the lack of a duty to defend or settle. A decision from Rhode Island and other states that use the tort of bad faith to force insurers to provide benefits the policy did not provide. As Justice Kaus of the California Supreme Court noted back in 1985, quote, "The problem is not so much the theory of the bad faith cases as its application. It seems to me that attorneys who handle policy claims against insurance companies are no longer interested in collecting on those claims, but spend their wits and energies trying to maneuver the insurers into committing acts which the insureds can later trot out as evidence of bad faith." This was White versus Western Title, a 1985 decision of the California Supreme Court. The decision in White versus Western Title was rendered on the last day 3 of the justices and the Chief Justice were forced to leave the court by vote of the public. Some speculate that spite against those who helped them lose an election, insurers, was a consideration for the decision. As a result of the White versus Western Title insurance company case, litigation and settlement in California, whenever an insurer was involved, became more difficult. An insurer could be held responsible for litigation tactics it found necessary to defeat a wrongful bad faith claim against the insurer, or what defendants claimed were wrongful litigation tactics when defending an insured. The case allowed evidence of settlement negotiations, usually protected, to be admitted to help prove the insurer acted in bad faith. The White decision that allowed such evidence in a bad faith case, and only in bad faith cases, no other types of litigation, has been criticized as unfairly compromising a defendant's right to defend himself. It is still the law in the state of California, although it has been weakened. When an insurer is sued, it could be charged with bad faith for taking what the plaintiff in a court felt were too many depositions, or filing unsuccessful motions for summary judgment, or failing to offer an appropriate amount at a settlement conference. It is now essential, before starting settlement negotiations directly or in a settlement conference or mediation, as a result of the White versus Western Title case, to have all parties waive the holding of the Supreme Court before negotiations begin. It does nothing to assist negotiation and does much to hold it back. Insurers, since they began the practice of requiring what is now known as the White waiver before discussing settlement at the claim stage and during litigation, have asked for a release to be signed by the insured stating the settlement discussions are kept private, and therefore the conduct of the insurer in providing any settlement discussion under the White waiver cannot be used to establish bad faith against the insurer. The decision in White versus Western Title has proved the adage that the road to hell is paved with good intentions. Although the court had the apparent good intention of protecting an insured against what it saw as wrongful conduct by an insurer, devastated the ability of insurers to defend themselves against unfounded bad faith lawsuits and encouraged more bad faith litigation. Critics of White and opponents of the admission of litigation conduct as evidence of bad faith raise 4 arguments. 1. There are sufficient existing protections. The trial judge, rules of civil procedure, and ethics rules protect insureds from improper insurance litigation. 2. relevance. The litigation conduct of an insurer's lawyer is only marginally probative of the insurer's claim handling. Furthermore, the prejudice resulting from placing litigation tactics before a jury substantially outweighs the probative value of such evidence. 3. Chilling effect. The possibility that an insurer's litigation conduct may be admitted as evidence of bad faith has a chilling effect on an insurer's defense. And 4. Attorney compromise. Attorneys for insurers will be unreasonably constrained in their advocacy and will be required continually to evaluate whether they will be advocates or witnesses at trial. In J.B. Aguirre v. American Guarantee Liability Insurance, a 1997 California Court of Appeal case, the court affirmed a judgment of dismissal on demurrer, holding a liability insurer did not act unreasonably as a matter of law in refusing to meet the plaintiff's $2 million settlement demand, despite the alleged risk of exposing the insured to uncovered punitive liability. The insured's alleged fear of the punitive exposure coerced him to contribute to a settlement out of what he alleged to be duress. Looking through the form of the transaction, the California Court of Appeal recognized that looking to its economic substance was important, and Justice Neal stated, quote, "What we have here at bottom is an effort by the insured to concoct a bad faith claim out of whole cloth with the ingenious assistance of counsel. The insured has attempted to position itself to pursue a high-stakes, bad faith case seeking punitive damages from which it hopes to emerge not only with the underlying claim disposed of at no cost to the insured, but a profit as well in the form of damages recovered from the insurer. Bad faith litigation is not a game where insureds are free to manufacture claims for recovery. Every judgment against an insurer potentially increases the amounts that other citizens must pay for their insurance premiums." Close quote. This was Dynamic Concepts versus Truck, a 1998 decision of the California Court of Appeal. The logarithmic growth of insurance fraud in the state of California and other states that have allowed tort damages for bad faith breach of insurance contracts may be directly traced, at least in part, to the judicial creation of the tort of bad faith. In my opinion, the tort of bad faith and the punitive damages that seem to go with it have served their purpose. Insurers now have professional claims departments. Insureds are almost universally treated with courtesy and respect. More than 90% of all claims are resolved without litigation or even argument. Legitimate claims are paid with alacrity. Insurance fraud continues to grow. The amount of money taken from insurers every year are in the tens of hundreds of billions of dollars. The fear of punitive damages has made the fight against fraud difficult and almost impossible. Even when an insured is arrested, tried, and convicted of the crime of insurance fraud or attempted insurance fraud, attempts will still be made to sue the insurer for the tort of bad faith. Before I retired from the practice of law, I contended daily with insurers who wanted to fight fraud, but who found they must decide to pay a claim rather than face the exposure of a punitive damage judgment. Sometimes the settlement of bad faith lawsuits, where there has been no bad faith, and an appropriate denial of a claim or refusal to pay a policy limits demand, the insurer concluded it must pay more to avoid a potential runaway jury. I can, as my mentors taught me 54 years ago, state with confidence the opinion that an insurer should spend millions of dollars for the defense of a non-covered or fraudulent claim, and not a dime for tribute to an insured who brings a spurious bad faith suit. However, practical insurance professionals have a need to resolve litigation as inexpensively as possible to protect the shareholders who want the insurer to make a profit. As a result, the insurer will disobey the millions for defense covenant and will make a business decision to pay the non-covered loss or the fraud rather than take a chance on an adverse verdict. As with all things in insurance, the attitudes of insurers move in cycles. More often than not, I am now called upon to testify as an expert in bad faith cases that the insurer insists on taking to trial by jury rather than to pay off a scofflaw. I can only hope that this cycle continues and more attempts at fraud are defeated. This video was adapted from my book, It's Time to Abolish the Tort of Bad Faith, which is available as both a Kindle book and as a paperback from Amazon.com. If you found this video to be interesting or useful to you or your colleagues, please pass it on. It's free. And please also subscribe to my Rumble channel, my YouTube channel, and my blog so that you can be advised of future videos and future blog postings. Thank you for your attention.